Hello everybody, this is Steve Rising with Thin Slice Trading at the Forex Trading Institute. I want to take a little time here to talk about very typical Forex price action, and one of the first concepts that a solid Forex trader needs to be able to identify and understand how to manage is the fact that a currency pair does not trade the same way a stock or a future trades. The primary reason for this is because of central bank intervention. So with a currency pair, we find ourselves in sideways conditions the majority of the time. So oftentimes the new Forex trader is looking for some type of trend-driven activity when in fact there is no trend there at all. And so we can see here for approximately the last 2 weeks, this particular currency pair has been trading in a solid range-bound condition, which once you start to understand this concept of range-bound activity or sideways price action, you then start to realize that there are some techniques and processes that will work trading in this type of environment, and there are also some techniques and processes that will not work. One of the benefits of the Forex market, it is the world's most volatile market. Another primary benefit is that it does have 5-day-a-week, 24-hour-day access, so it's a convenient market to trade because of the 24-hour-day access. And it is the most volatile market in the world once again, which means from a trader's perspective, volatility is a good thing. Another common issue that I see with a lot of traders is they really approach the market with an investor's mindset. And you really need to have a different paradigm when you look at price action and look at getting involved. And the Forex, or for that matter, any market, when you're looking at it from a trader's perspective. The reality is a solid trader with the Forex market, or for that matter, any market that they're a master at, the solid trader knows ahead of time exactly what type of condition that they're looking for and exactly what they'll consider to trade. Where the new trader oftentimes is under the idea or misconception that they can simply sit down, turn on their computer, and log in, pick up one of their favorite currency pairs, and then decide to trade it. And it may not be that at that particular time on that particular currency pair that there are solid or high probability trading conditions. But once again, the first concept that one needs to grasp is the fact that we are in these sideways or range-bound conditions. In this case, we can see that actually the bottom of the range is a little more clear to identify, where we can see prices held at this particular point right here. Our top of range a little more choppier. We've traded up in this area right here. The benefit of that is it means that we can look for instance, reversal strategies when price moves to the bottom of the range. We also know that typically what creates in Forex what we call here at the Forex Trading Institute momentum, as opposed to any true trend-driven activity, simply because momentum relates to short-lived movement, and trend-driven activity refers to the overall tendency of a market. So really, trend-based activity, it's a very misused concept in today's online real-time market trading. It's a very misused concept. It's been around for decades, was really effective prior to having online access or prior to the solo trader having the ability to have access to real-time charting. The concepts of being able to trade intraday activity or intraday reversals just weren't available to the individual trader before the internet. So it's important to understand as well that oftentimes some of the trading processes that one's looking at are not really up to date or applicable in today's fast-moving, real-time online trading marketplace. At any rate, we can see here where as we reach the top or the bottom of the range, we know eventually price is going to break that top or bottom of range and have what's called momentum-based activity. And typically we can even look at the economic calendar. For instance, on this pair we could look for, this is the New Zealand dollar versus the US dollar. We could look for this pair when it has its next rate announcement is a good time to look for price to break that top or bottom of range. And then all that happens is it simply moves into another range. So we can go back here on this particular pair here, and this is in fact a trading range right here. It was just a little shorter, and then we had a little bit of bearish momentum. And keep in mind that this is a daily chart that you're looking at here, but that doesn't mean for the entire day price was moving south or that it was actually any true trend-driven activity. The other characteristic of Forex is typically you get 1 or 2 moves in a 24-hour session that happen in typically under 30 minutes that then creates price closing lower than it opened, which then creates this large red candlestick that we have right here. So it's really, once again, is just a couple of moves that generates that overall activity. We can see here then we actually hit the bottom, price reversed, it closed out. We're bullish and bearish back and forth, price trading in either direction, and that's another critical concept to the new Forex trader, is to understand that in this marketplace, price is changing direction frequently. Typically, every 4 to 6 hours, we'll be moving north in one session, hit the top of the range, reverse, move south in the next session. And there again, you can see on this pair, we have another range right here at this point right here. Little transition period, but it still was sideways activity because price was bullish one day, then bearish the next day, range back here. And there again, in closing here as well, the key to becoming a consistent trader, in this case we're focused on the Forex market, is to also start to learn to watch price unfold. Oftentimes we have a tendency to spend so much time looking at old price action, and then when we're in front of real-time price activity, we're outside of our comfort zone because now all of a sudden price is moving and it's not creating exactly the condition that we want to see. So my recommendation is, for instance, to take and start with today's candlestick, which is right here. And the only reason why you use a Japanese candlestick chart is it's simply easy on our eyes. We're not looking for any classic Japanese candlestick patterns. It's just easy to interpret. And the easier it is to see, because trading, especially trading from a chart, is a very visual process. So the easier it is to identify what we're looking for, obviously the more consistent we're going to trade. So then the recommendation is to wait 24 hours and mark that candlestick and then watch another candlestick. And give yourself 5 or 6 days. It takes a little time, but that's the benefit of really of learning to trade, is give yourself ample time. Sometimes we look for that instant gratification that many of us are akin to gravitate to, and then with trading it really is just like learning any other discipline. We need to give ourselves a chance to really see price action unfold. So once again, this is Steve Rising with Thin Size Trading at the Forex Trading Institute. Thank you for your time.